Hello, everyone. Just give me a second before we go live. I need to sort out something technical, and I will be right back with you. Okay? Give me a second. Thank you. So I'm back with you guys. Hi, sorry for the delay. Was trying to multi-stream, but apparently it's not that easy, and it doesn't seem successful. Nevertheless, so this is a continuation of our seasonality webinar. Remember, for those that they have been here, we cover December, the seasonality in December, the phenomenon so-called Santa Claus rally, how you can spot that it's a year of a Santa Claus rally or not. So we have seen all this in the previous. Okay, can see Panayotis, welcome. So. As I was saying, we have covered December seasonality. So today we are moving forward to January to see what the history of the markets, um, uh, what they have showed for January. Seasonality might not always takes place. Remember, it depends on the economic conditions that we are facing, or whether we are in a recession or not, or in a bear market, in a bull market over the year, and so on and so forth. But I'm going to explain everything soonish. So before we officially start, I need to go through the disclaimer warning as usual. So let me, I think you cannot see me. Yes, and I think that's absolutely, yeah. So I'm gonna just, okay, you know what? I will just enable and disable the camera once again. Give me a second. Okay. As usual, if you're facing any audio or visual issues, please let me know as soon as possible. And camera, is it on? Should be on. Can someone tell me whether you can see me? I've lost my camera. So many windows open that I have lost track of it. And the question box. Guys, hello. For all the people that are here, can you give me feedback in regards to the audio? And whether you can see my screen, my face, you can hear me. Anyone? Yes, no. Come on, come on. Okay, John. Can see and hear. Perfect. You can see my camera as well. Perfect. That's good. That's brilliant. So, yeah. So, okay. Perfect. Now, okay, let's move on. Disclaimer. Actually, I left it for a while. So you see it, I'm not gonna go through it, okay? And I will just, sorry. So let's move on. Just okay. Just a quick refreshment, you prefer, on what we have seen so far in the 2022. And that's why I'm gonna put the very next slide on, which is, I mean, illustrations tend to help more on understanding what we are seeing. And there is a bit of a delay. Come on. Okay. So over the years, guys, we have seen several factors driving the market and leading to, especially in the stock market, leading to a really significant drift. And this is the example of an S&P 500, otherwise USA 500, that you can see per event how it was affected. So it was okay. The pandemic, it seems that it was always in the background, even though it's been 2 years now. We went in the third year, but on top of that, we had the supply chain disruption. We had the the Russian-Ukrainian war. We have a lot of hawkish from global central banks, coordinated ones, excluding Japan, something that is actually adding pressures to the stock markets. The higher the interest rates are, the more the pressure on the stock markets, because they tend to lose their attractiveness, if you prefer, for the investors. So we have seen, especially, we have seen generally a really tough year. Okay. Um, so whether we have, okay, we have another 2 weeks until the end of the year, but whether that will be the end of this downtrend, or whether that will be, whether we're going to have a sign of markets bottom or not, is not something that we can tell for the time being. That is, the markets haven't seemed to settle. There is a lot of volatility, especially from the geopolitical perspective and political perspective, and central banks mainly. So if I had to choose the top reason for driving the stock markets this year, would be the hawkish of the Fed, the hawkish of the ECB, the hawkish of the Bank of England, especially the last quarter. Okay, especially the last quarter, that we can see more, even a bit of a delay tightening, and more coordinated tightening. And I would like to remind you that okay, regardless of what has been driving the market, and so I'd like to remind you that we have seen a lot of comparisons, um, um, comparisons this year, more precisely, with the 2008 crisis. Okay, um, and that's why a lot of analysts, a lot of economists are keep saying that we have a pretty clear bear market in stocks this year. And the important thing now to monitor, or to investigate, to find out, is whether 2023, the year ahead, will be another bear market for the stocks. And that's why the seasonality matters, because depending on how December will close, how January will perform for the stocks, it will give us an indication for the 2023. So January, and the price fluctuations that we are seeing usually in January, is like a hint on what could follow. okay? And what could follow. Of course, nothing is certain, right? But it studying the history of the market, of the financial market, we have seen some common reactions, performance, if we have a pretty bullish January, and what that implies for the rest of the year, or if we have a really bearish January and what that implies for the future. When we have a really bearish January during the recession years, or whether we have a really strong January during a recession year. So everything matters. So so this is what we're gonna see today is actually based on studies, and more something actually that has been David Schwartz study. Okay, we're gonna see that based on some based on the history. I mean, studying the history of the financial markets, we're gonna see how we can, by checking the performance of January, what we could conclude. So, what else I wanted to mention? Okay, actually, before we start, very, very briefly, okay, just to remind you, everyone, guys, if you have any questions, interrupt me, okay? Don't worry about it. Just tell me, let me know. Just to I have some stats over here. I have a chart, up-to-date chart. The latest, I actually took the screenshot today. So here you can see how the S&P 500 sectors. So you know, S&P 500 index is it has 500 components, right? So companies tech companies, real estate companies, energy related companies, financial services companies, healthcare companies, and they compose this index, the S&P 500. So over here in this chart you can see that, okay, let me zoom in actually. Can I do that? I think I can. Yes, you can see that everything was under pressure. It was in a decline. It is in a decline the whole year, except from energy, and that was because of the higher energy prices that supported companies that are related to energy, like ExxonMobil, or everything that that is energy related. I'm just I'm in a blackout right now. But all the rest, healthcare, financials, real estate, would be housing sector would be very, very significant as we're moving to 2023, because you know, in every recession, one of the sector that is hidden the most, one of the sectors that is hidden the most is also the housing market. People are in mortgages with higher interest rates to pay for their mortgage, and whether they will be managed to repay. That's significant because we have an increase in interest rates, right? We have higher interest rates. So the only beneficiary this year, it was the energy sector. But overall, the index, the S&P 500, had one of its worst yearly performance since the crisis of 2008. So there is a lot of comparison between 2008, because it was global recession, right, in 2008. So we have we have found some commons that actually imply that we are in a recession years, and more are coming in front of us. Also, Nasdaq 33% down from the beginning of 2021, having its worst downtrend for Wall Street again since 2008, with the majority of its individual stocks making up the index falling much further. And okay, I found this in a in the bar chart website, where you can find all the performances, historical performances for many assets. So as I said, a reason for that, a reason that um, that the 2020 pandemic crash, the Ukrainian war, the tightening of the Fed, and in general the global central banks, um, they look like they present some similar um, performance like previous crises that have fueled the bear market, such as 2001 dot-com bust, 2008 housing-related financial crisis, and etc. So the only thing that is different that we could say for the time being that is different between those crises and today's is that policy tightening, okay, will likely be the cause of economic slowing, okay. So with because central banks wanted to control inflation, they have reacted so aggressively that they led to this economic slowdown. It's not like the housing related crisis back in 2008 that it was the housing bubble. It's not like the dot-com burst back in 2001. Now it seems that the increasing inflation and the need from the central banks to control inflation is what has um, um, what has likely caused this economic slowdown which we expect to see, especially in 2023. So this kind of what we've seen this year, I mean, recession caused by tightening central banks due to higher inflation in general, is something that historically leads to a bear market, but a more prolonged one. So, okay, nothing is certain for sure. It's just what history says, what history has proven. But yeah, this is what we have seen so far. So the forecasts for the time being is that the 2023 and 2024 will still show clearly the aftermaths, the consequences of all this tightening, especially in the stock market. Now, what else I wanted to add before we go to there's no question, so I will move on. Again, okay, you can have a look at it later on. I will provide the slides anyway. Actually, let me provide them right now, because otherwise I will forget. I will put them on. Okay. It's together. It's a December rally, the one that I have done in the beginning of the month, just for those that they haven't attended the December webinar. I have both of them over here. Okay, so uploaded. Perfect. So let's move on. Okay. So, okay, as I said, my presentation is based on this book. Okay, this book goes back and studies the Mr. David Schwartz, which I cannot pronounce his name, I never could, based on the history of the stock market, has studied the trends, the seasonality, the reactions, the behavior of the market. So this is where is the December's webinar was based, and today's webinar was based. So over here you can find, in this book, you can find the year's best days, the year's worst days, the months in which we have seen the prices that they have higher possibilities to rise. So this is based on empirical study and historical study with possibilities on how each month tends to perform. So the reason for January effect is that it has it has been seen that January is one of the busiest month of the year. Okay, first of all, people are coming back from holidays. Institutions as well. I mean, the big institutional players as well. The big investors are coming back from the New Year's and Christmas holidays. Markets are open again. So, and there is some particular, some common performance in January that has been seen throughout the years, and that's why it was called as January effect. Okay, which we're gonna see right now. So, so there are many people that they believe, as I said, that the January is the very first month of the year, right? So it's an indication of the years of the entire year's performance. So it is a seasonal effect, but it's considered to be seen as one of the best months of the year, with since it has been seen that 76% of the time we've seen a rally in January. And of course, every month, like this is similar with the webinar I've done in December. Like it's split in 2 weeks. We're gonna see that later on, but um, um, the third quarter of the month especially, and where we have seen the earnings, the companies releasing their earnings as well. So the third quarter of the month, the third week approximately, between the 15th to 23rd of January, has been seen that has shown above average strength in the years in the history of the financial markets, while the final quarter is also tends to be bullish, 17 out of 20 years. So based on the data, based on the history of the market, we have seen that the January, okay, January tends to be a very profitable month if we are in a bull market year, okay? But according to the data, it takes us back to 1928. So I'm not referring just the study, the last 20 years, but more than 100-year study. So Mr. David and many other analysts and economists have been saying that during a bullish year, economic growth and etc., January tends to be a very strong month. But usually if it's a bear, if we're in a bear market, January tends to be a very disappointing month. Okay, so this is what we're gonna see today. So you can that hopefully will help you in the upcoming future, and will give you indication in regards to the year's performance. Now, so January and January effect, the so-called January effect, have been proven up, as I said. It's a seasonal. I mean, it's a. Let me just this better. Yeah, I prefer it this way. So as I was saying, January effect is a seasonal increase in stock during the month of January. If we're in a bullish year, if we're in a bearish, it's a seasonal decrease of the stock prices. We're referring only to stocks. We focus on stocks. Okay, this mainly affects the stock market. So analysts and general global analysts, economists, etc., generally attribute this rally to an increase in buying, which follows the drop in price. That typically happens in December when investors closing booking positions, engaging in tax loss, harvesting to offset realized capital gains, which prompts usually a sell-off. Another possible explanation why we have this, why we are seeing usually this, is that investors use the year-end cash bonuses to purchase investments the following month. So people, as I said, are back from holidays. If they have taken their bonuses, they have money to invest again. Or it might be just the fact that in December we have the holidays, people are on holidays, they don't really invest or trade or opening new positions and also they are coming back in January to reinvest for the new year. So what else? Also, let's not forget that December is the last month of the year and is the tax year ends, right, in December. So people have a lot of profits. They have to pay a high. If they have a lot of profits, they have to pay investors. Okay, in general, they have to pay a high tax bill, right? But not if they sell their stocks before the end of December. So that's why there is this seasonality that December is a bit more um, 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 soft, could say. Before, because the main usually the big investors prefer to sell their stocks beforehand, before the year end, so their total taxable income goes lower and they have to pay less taxes. But there are different many factors that they are taking place. It's also we've seen central banks, we've seen a lot of geopolitical and political um, factors as well that could add to this rally or to this drift. Anything else I wanted to add over here? I think not. Just one more thing. Let's not forget also the psychology of the investors, okay? Of the investors, of the traders. Don't forget that many investors follow up on New Year's resolution starting from January, and the momentum and the um, and the energy associated with the need to start investing for the future rallies a peak in the stock market. That's also um, and also the well-known window dressing, if you are aware of what I mean. So what I mean by window dressing, dressing is when an institutional investor, banks, big companies in general, mutual funds, hedge fund managers go shopping at the end of the year for stocks, though not for clothes, for stocks. So they are trying to find stocks that are considered to be good for investing, stocks that have outperformed, in order to deceive individual investors that they have a successful portfolio, to show their clients that, oh, here we are, we have a really good portfolio, very successful portfolio, while in a sense that there might not be very very successful throughout the year, but by the end of the year they're trying to find and to invest in stocks that perform really really well, in order to uh, present that to their potential clients. Okay, so we have mentioned investor psychology, repurchase. So these are some of the factors that could that are responsible to this seasonality in these two January effect that we tend to see. But let's move on to more, more numbers, more. So um, okay, this is just for your own curiosity, based on the performance on the study from 1928 up to 2018. You can see that 56 out of 91 January was in a rally with more than a 60% gains. Okay, while um, between 1970, sorry, up to 2006, so for 36 years, um, uh, there was an even greater rally for S&P 500 in January, with 86% chance to rally or in general being bullish for the whole year. You can see that this is the likelihood of the price to rise, particularly for S&P 500 and stock market, the US stock market in general, or UK stock market as well. So January is the most successful one. Then the next one is April, which is also the second most the second best month of the year. I have somewhere the months. Where is it? I have a note on that one, didn't I? No, apparently I don't. Okay, never mind. So January, April, August. So these are the top three best performing month for stocks. So let's move on. Even some more recent stats back to 1950 up to 2020. Okay, we have seen that based on this calculator. This calculator is online. I found it online, by the way. So based on these results, it looks like some months really are significantly better than the average. Some Januaries are significantly better than the than others, but there are 43 years that for 43 years January was in gain, while 28 was down. So 43 out of 71. Okay, we had a bullish January. So seasonality is still on even up to this moment. So let me just okay. You with me so far, guys? Is everything okay? Do you want me to speed up a bit in order to go straight to the steps? Okay, I will leave that to study yourself if you prefer, because yours already 40 minutes past the hour, even though we started a bit late. But here, okay, we spoke in the last webinar in regards to December. The January effect actually it depends from December. So whether January will be good or bad or neutral depends from whether we have or not, we had or not a Santa Claus rally. So I will remind you that Santa Claus rally is a year-end rise in stocks, which we haven't seen yet, right? Are you with me? So if I put my MT4 on and I go to S&P 500 or Dow Jones, here we are. For the time being, this is December, okay? Let me just put the beginning of December. Yes, the beginning of December was here. And we are in a downtrend. So we haven't seen an actual Santa Claus rally yet, okay? But we have another 2 weeks. This week, which is a full trading week, and the week after. So Santa Claus rally usually happens in the last 2 weeks of the year, as I said in my previous webinar. So everything depends on that. So because if we see and indeed a Santa Claus rally, then this could last into the new year, so into January. So this rally usually starts, as I said, the week before Christmas, so now, which is something that we haven't seen, okay? And it tends to end by January the 4th, okay? So just to make it easier for you, by the fifth working day, the fifth, sorry, not working, the fifth day of January. So it can begin any time in December and will last until the fifth day of January. And that's where it gets its name from, Santa Claus Rally. If this rally occurs a bit delayed, then it could bode well for stocks in January and the rest of the following year. But if it fails, okay, which this seems the case so far, okay, this is the daily chart for S&P 500, and since the beginning of December, we are seeing the S&P from 4,4100s level drifting to 3,700s. So we are down. So if Santa Claus rally fails, that could turns the traders to sell stock even more aggressive in these very last few days of December, in order to get rid of their losses as tax writes off. So if the Santa Claus, if the rally survives tax selling, some traders buy stocks in early January because they are cheaper. But we need to wait and see. So the last 2 weeks are crucial. The last 2 weeks, this week and the week after, and the very first 5 days of the January are significant. Okay, so the first 5 days of January, I think I have it. Sorry, I will get back to my slide so you can see it. The first 5 days of January, okay, can help us predict the rest of the month, the rest of January, and the rest of the year. So in years that a Santa Claus rally occurs, and it lasts until the fifth day of January of the new year, it has successfully predicted the direction of the S&P 500 33 out of 39 times, with gains approximately 13% higher. Okay, so the strategy over here is to wait until the first 5 trading days are over in order to make any decision about jumping into the stock market in a buying position or in a selling position. If the Santa Claus rally fails, not happening, or if we have like a tiny rally, possibly fake the rally in December until the very first days of the year, then um, if you identify a mixed picture by checking the last 2 weeks of December and the first 5 days of the January, if there's no clear indication, no clear direction, then possibly January effect is not happening. Yeah, so that's another comparison of January's effect from 1958 up to 1999. I'm not gonna spend more time on it, and I will go straight to what the handbook is suggesting based on the history. So how you can identify whether you are in a bullish or a bearish year. So there is a high likelihood of bull market in January if there is in the stock market, okay, if you're going to check your S&P 500 or Dow Jones, etc., if there is an average profit of 4% or an average decline no more than 1.6%, here it is, okay, then this has more possibilities of us seeing a bullish market in January. If in a bullish year, in bear market years like the one that we went through this year, January rallies are low. and greater or equal to 1.81%. Out of curiosity, I would like to check January's 2022 performance. So January 2022 performance. So let me zoom in. Are you with me, guys? No one is speaking, no one is typing anything. Am I speaking alone? No. So I will go back to January 2022, so this year's January, to see how it performed and whether we indeed saw a January effect. So January started 7, 6, 5, 4, 3, 2, up here. So January started here. Oops, wrong animation. January this year started here and ended. So that was the first trading day, first day, second day, third day, fourth day, fifth day. This is the fifth day. So if I do the maths behind it, let me do the maths. So to see how the very first 5 days of the January performed. So from 4773, so there was a decline of more than 2.2%. So there was decline. So you see a decline of more than 1.8%. It was actually 2.2. Here it is. Okay, 2.2. So that was indeed an indication that we're gonna have a bear January and possibly a bear market year. And this is indeed what happened. So the January closed somewhere here. So it closed here, right? Closed here. So well below the beginning, the open price, okay? And having already drifted significantly, that should be more than 10% decline, okay? So it was a good indication indeed. If I zoom out, then we're gonna see the whole year, and I will put the weekly chart just to be easier for you to see this trend. We can see that it was a down channel for the whole year. So indeed, last January, we indeed saw the January effect coming in place and indicating that we're gonna have a negative, a disappointing January and possibly a bearish market year. And indeed, this is what we have seen. So this is the way that you can monitor or study the performance of January as we move in. Actually, the performance of December and the very first 5 days of January once we are into the new year. It's crucial to identify whether you are in bear or bull market because you can do your arrangements, you can be in the line of the trend, you can open long-term positions, you can invest if you are an investor in stocks and in general. So you can sort out your long-term portfolio. Okay. Now, I mentioned the 5 first days of January. Then mentioned what you should take care of December. So if December closed on the 30th, December closed with declines more than 80%, 0.8%, then we might see a bear January. If December closed less than 0.80% decline and up to 2.9% gains, then we might see a bullish January in progress. That's examples that you can study because I don't want to keep you for long because we have already seen an example, a real-time example actually was this week's December. But this is the way that you can, this is an examples of a bullish year actually. Up. Yep. So Okay. Now, benefits of January effect. I'm not sure whether it's good to think it goes to think good thing to state them again because I already did. It gives uh, the chance for you to be on the correct side of the market, limits your risk. So, despite the view that the market rally provides minimal profitability due to its short period and substantial transaction costs that could eliminate profitability in a buying and selling or the other way around. However, if you look at January on a market cap weight basis, the effect is still more pronounced. So possible benefits that can occur to stocks investors include predictable seasonal fluctuations, right? Typically spans December and January, enable stock traders to account of certain price variations and take advantage of market volatility in order to determine their entry, their exit point, the expected profitability. Also presents a chance for you to make the most of the year-end losses, which can later be declared as a loss on an investor's next tax return. Also, you can reinvest your money from years and tax selling in December, but hopefully more predictable, profitable way, profitable stocks. Also for investors and traders, but both of them. For investors, they have the chance to take advantage of the okay year-end bonuses if you are gaining some. Um, and don't forget that um, it's good to be on the side of the market, to spot the side of the market and to be on the side of the trend, as we said. Send is our friend. Um, what else I wanted to, but okay, I mentioned a lot about investors. That's the same stands for traders. And anyway, don't forget that we have stocks which you can invest on. We have also stocks for trading, but we have more than 1,000 stocks that you can invest if you want to diversify your portfolio and have a separate career in trading, a separate career in investing, and make your investment, etc. So this year, we as HFM gave our clients the chance to invest in the market as well, to invest in stocks, in companies that they like, in companies that they are interested to them, and benefit on dividends, returns, and etc. How will you treat January effect? Risk management, of course. Always have a plan. Stick to the percentages that I gave you based on the study of Mr. David Swanger. Um, always risk management and planning comes first. Check the financials of the company that you are ready to invest. Check a bit the financial reports. Um, so perform due diligence, as we say, before executing a trade. Stay up to date with the markets, with the news, with the headlines, with the politics. Or if you're not thinking on investing on S&P 500 or Dow Jones, which are US indices, you're thinking particularly to invest stocks, to particular company stocks, etc., then you need to keep yourself up to date with what the company revenue is, the company loss is, the company earnings per share is, and etc. Or you can focus on the short-term positions if you prefer. You don't need, you are not interested in long-term positions, um, and apply the strategy that suits you, but in stocks. And based on the January effect, if you have spotted that indeed we have a January effect taking place this year, that might point into a bullish market or a bearish market. Um, what else? we said. So this is a few more information in regards to January. We said crucial is the end of December and the very first 5 days of the January. If so, the very first 5 days of January is this first quarter that I'm stating here. So if it's a bullish one with from 0.80% losses up to 2.9% gains, somewhere between that range, then we tend to have a bullish January. If now so that is something that is not certain. I mean, we need to study, as we said earlier, whether we have where is it whether the 5 first days have posted a gain or they have posted a loss more than 1.80%. If they have posted a loss, then we expect the January to fall even further. If they have posted a decline less than 1.6% and up to 4% profit, then it has to be a bullish month. Now, the second quarter of January, so that should be between 7th to 14th of the month, 7th and to 14th, tends to be the weakest of all. It might be consolidating, it might be a bit lower again, etc. It might be the weakest from volatility perspective, and etc. Especially the 11th of January tends to be the day that we might see the biggest um, decline in this week, in this quarter, in the second quarter of January. Sorry, first quarter is from the 1st of January until the 6th. Second quarter is from the 7th of January to the 14th of January. Third quarter is from the 15th up to 23rd. And 23rd tends to be the worst day of the month and the 9th worst day of the year. So you're gonna figure out whether you will decide to enter short or long, but don't be blinded. Not because the history shows that is the worst. You're gonna open your PCs that morning and go short without checking your charts, without checking whether this is happening or not. Okay, I don't want you to be blinded. This is empirical data studies. Something might happen, I don't know, from politics perspective, something that could change everything. So I want you to also check your chart to trade what you see, not only what you think. Okay. Also, the fourth quarter, the final days of the January tends to be um, um, tends to be also negative with only 2 profit maker quarters out of 48. So the possibilities of a rally in the last final quarter of the year are very, very low. Now, that's not true. As I show you data up to 2022, it seems that, and today, this year, 2022, we have seen that it seems that January effect is still important. It might not always occur, but for the most of the time, it does occur, as studies have proven, and as this year has proven, right? But even if you spot that wasn't a clear indication from January, or even if we found that it didn't take place this January, then that costs you nothing. You will keep monitoring your charts, you will keep monitoring your prices, what the candles can tell you, what the trends can tell you in order to take your trading decisions. Seasonality exists, and I show you that by presenting you the performance of S&P 500 this year, and that January effect indeed took place. But it's not just one piece of investment puzzle. Unfortunately, there are a lot of factors that affect the market, so the performance can never be guaranteed. Seasonality is one of the many, many factors that affect in the stock market, but we have many, many others that could affect it. So we need to keep ourselves up to date with everything that's going on around us. Opportunity or not, either way, keep monitoring your charts, keep monitoring the news, try to make informed choices, technical analysis as well before you enter the market, risk management. Okay, there is nothing guaranteed in life, and there is nothing guaranteed in markets either. Okay, so try to have the possibilities on your side with fundamental analysis, seasonality, technical analysis as well. So if all three agree, then it seems that you might be on the right side. Thank you very much, guys. I didn't have any questions. I don't know, maybe a bit boring. I know it's a very, very theoretical subject, so I do understand if it was a bit boring. I will call it a day if you don't have any further questions. I have uploaded the slides. So I will call it a date. If you have any questions, please don't hesitate to contact me at webinars@hfm.com email address. Happy holidays for anyone that is celebrating Christmas. Happy New Year's, because we won't gonna be here in the very last week of the year. Don't forget that markets are closing early on Friday, and they will be off as well on Monday. Thank you very much. Have a great day ahead. Take care. I'll see you soon. Bye bye.